Today, Operation Anti-Spruik, Episode 3. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Yesterday, I made a long show about mortgage stress and went through the latest mapping and also the postcodes, and at the end started to talk about some of my modelling and how that works. Today, I want to take that slightly further, and with the help of some examples provided by Cookie Boy, thanks Cookie Boy for your help with all of the data here, I'm going to go through some recent price reductions on properties across the country and also draw some correlations between those reductions and the data that I also hold, because there is a very interesting trend here that's worth exploring. So to start, we're going to look at this property, which is in Shepparton, Victoria. Postcode actually is 3616. And it was on the market in early May for $870,000. Now the price is $659,850, according to the portals. So a considerable drop. And of course, the real question that's worth exploring is, so what's going on? If you look at this particular postcode, it's at Tatura, you'll see there's some really interesting data. The first point is that it's a relatively small postcode in terms of the number of households who are in the area. But nevertheless, half of them are in mortgage stress, 40% are in rental stress, and there is also a little bit of investor stress there too. Looking at the trends in terms of values over the next 3 years, and as I've explained before, I use different scenarios, the best, the base, and the worst case scenarios. The best case is everything goes really well with the economy. The base case is what I think is the most likely at the moment. And the worst case is if things go really bad. For example, we have issues with China, or the Ukraine thing blows up further, or we move into a deep recession. The point about the base case is that it also holds the greatest probability in my modelling at the moment, typically about 50 or 60% probability. So you can see there that I'm projecting over the next 3 years for the base case on house price growth of a fall cumulatively about 16%. Units, by the way, would be cumulatively down about 12%. There is a best case which would have a slight rise, just over 6% over 3 years for houses and 5% for units. But the other interesting observation is the investment returns. So the gross investment return, which is the one that they always talk about when they talk about this sort of stuff on property portals, is the relationship between the rental that you can get versus the price of the property. But that is not a very good way of looking at the truth. What you need to look is at the net rental return. And unfortunately there, the net investment return, that includes all the costs, including covering the cost of the mortgage, the management of the property and repairs, all those other things, is minus 3.9%. Now, of course, it's one of the reasons why we have stressed investors showing up there on the list, quite a small proportion, but quite relevant in terms of trying to understand what's going on. So my thought here is that this particular property is an example of what happens when you have high levels of stress, high levels of issues with regard to returns on investment properties, and despite the small number of households, the trajectory is looking relatively weak. So therefore, perhaps no surprise that prices are down in this particular area. Now, let's go to our next example. This is a South Australian example, postcode 5540. And this one was on the market for $119,000 in May 2021 and was dropped to $99,000 at the end of last year. Interesting that there's no change since then. And it's been listed for a long, long time and hasn't sold. So you might surmise there's something significant with it, despite the fact that the price sounds, well, quite reasonable when you think about where it is. Now, what we should then do is to look at the data for this particular postcode once again. And in my model, The first thing you notice is, well, there are a few more households in the area, in Port Pirie, but there is 44% of households in mortgage stress, 39.5% of renters in rental stress, and we have some stressed investors there too. The overall financial stress level is at 43%. That's quite high. In terms of projections for the next 3 years, on the best case scenario, there is still a line to, let's say, 12% over the next 3 years. Best case for houses and 9% for units. But the base case is a fall of about 10% over the next 3 years. And for units, about 8% down over 3 years. And here the gross investment returns are just over 4%. The net investment returns are just positive, but only slightly above zero at 0.9%. Now let's look at this property in Seven Hills, New South Wales 2147. It's a house. It's got 6 bedrooms, 4 bathrooms and 2 garage spaces. When I first looked at it, I thought that it was actually an apartment, but no, it does seem to be a house. And essentially it was listed around 2.9 to 3.2 million back in 2021, but now it's dropped to 2.75 to 2.85 million. Priced to sell, they say. So before we look at my data, let's look at another one in postcode 2147. This one was originally listed for 950,000 on the 11th of May, and it's now been dropped to 930,000. It's a 6-bedroom, 2-bathroom affair and a house again. So looking at this particular postcode, it's quite interesting to see, firstly, there is some mortgage stress, but it's not very high, around 20%. But rental stress is a considerable issue. We do have some stressed investors as well, and overall financial stress is at 46%. So that's consistent with a little bit of trouble in the area. In terms of price scenarios, the base case has a 20% fall over the next 3 years. The best case would be a small rise of about 2.5% over 3 years, and the worst case, nearly 40% over 3 years. For units, a small rise of 1.8% over 3 years is the best case scenario. A drop of around 15% for units in the area is the base case, and the worst case would be about 28%. And the gross investment returns at 3.5% gives a net investment return of just 0.2%. One of the reasons, perhaps, why some stressed investors exist, because they find great difficulty in getting a return from this investment, particularly if the capital appreciation goes negative. Here's another example, a Queensland postcode 4870, and this particular one was listed 118 days ago, and it was 1.999 million. Now it's been reduced to 1.75 million. And again, it's a house, 6 bedrooms, 6 bathrooms, and quite a large square area as well outside. And the interesting point about this Queensland story is it's another example of what I keep seeing, because so many people have been spruiking Queensland as prices are still rising, and yet a lot of the listings that I look at, they're going the other way. So something isn't actually telling the complete story, but certainly across many postcodes we are seeing pricing falls now. And if you look at the data set at 4870, which is up in the Cairns area, by the way, you can see there that the stress levels are reasonably high, but not above the 40% threshold. When they turn red on my model, that signifies significant pressure. So there's some pressure, but not a huge amount of pressure. And in terms of the growth of price, on the best case scenario, you might see 18% over 3 years, but the base case, the most likely scenario, is a fall of about 5% over 3 years for houses. Worst case, about 23%. For units, best case would be a lift of 13.5% over 3 years, the base case down 3.8%, the worst case 16.9%. And looking at the investment returns, the gross investment returns about 4.4%, the net investment returns 0.9%. So again, not particularly flash when it comes to a property investment in the area. And in fact, I'm seeing quite a few postcodes in and around Cairns where there are considerable issues and considerable price drops at the moment. Let's have another look at a Queensland postcode. This time it's 4865 Little Mulgrave, and this is vacant land. Now, it was originally on at offers over $2.3 million. That was back in March 2022. Now, on the 25th of May, it was shown at 1.95 million, negotiable. So whilst this is land rather than a property, I thought I would just highlight the fact that in this particular area, it's quite a small area up in the far north, the trajectory for houses, best case, is up 20%, but the base case is around down 3.2% over 3 years, the worst case down 21%. For units, up 14% best case, the base case down 2%, and the worst case about 15% down. And once again, the returns come out about 4.4% and 0.9%, so not hugely flash once again. And once again, I'd highlight this is another in the sort of the Greater Cairns area, where, as I said before, there are a few issues. We'll go to another Queensland property, 4852, listed 433 days ago, back in 2021, at 3.8 million, dropped in the middle of last year to 2.94 million, and now it's at offers over $2 million. And it's a reasonably large property. And if we look at the data from my models, again, it's up in far north Queensland, in the Greater Cairns area. And once again, it's interesting to see that there is a trajectory for price rises in the best case scenario, up about 6%, but the base case is a fall of about 16%, and the worst case could be as bad as 34% down for houses. Units up 5, best case, base case down 12, the worst case down 25.8. And here, the gross investment returns about 4.6%. The net investment returns out after all the costs. You pretty much break even, but you don't make anything at all. So unless you're going to see capital gains, an investment doesn't make a lot of sense. And then I thought we'd come to New South Wales, to Westmead, postcode 2145. So this property was listed 223 days ago. It was passed in an auction, and the quoted price was 1.59 million. Now it's on the market for 1.49 million. And this is a house with 3 beds, a bath and a garage, but of course they're selling the prospect of the redevelopment value of this particular property, I suspect. And it's quite interesting looking at the data once again. We find that whilst mortgage stress is okay at 24%, rental stress is a real issue. Stressed investors at 37% is quite high, and overall households in financial stress is more than half of households in the area. And this area has quite a few households in it. It's 27,000, of which 11,000 are borrowing, 12,000 are renting, 8,000 are investing. And looking at the price scenarios, the best case scenario would be a lift of 1.9% over 3 years. The most likely is a base case fall of 21% over 3 years. The worst case is a fall of nearly 40% over 3 years for houses. And by the way, for units, about 1.4% best case over 3 years, down 15.7% the base case, or down 29% the worst case. And interestingly, from an investment perspective, the gross investment returns typically around 3.2%. But the more realistic net investment returns are negative. So the chances are, if you're an investor in this area, you will be losing money on a cash flow basis. And so unless you really believe that there's going to be much stronger capital appreciation than certainly my models are predicting at the moment, then you probably wouldn't touch a property in this area. So I think that's enough for today. I guess 3 points. The first point, my scenarios are based on current assumptions. They will change. They're not in any way a price prediction, so please don't hold me to them. My disclaimer is very strong here. It's simply saying it's based on my best available information at the moment, but it will change. The second point is there seems to be a high correlation between price reductions and enhanced levels of either mortgage stress or rental stress or both. And there does seem to be a consistent pattern. properties in areas where stress is higher are being discounted more significantly. And I could do a lot more work on that when I have time, perhaps I will. But of course, if you want to, you can get hold of all of the data for all of the postcodes by subscribing via our Patreon program. I've had a few people subscribe in the last 24 hours. Great to see you join. And of course, that gives you access to all of the information, like I've shown today, across all of the major postcodes that I examine across the country. And we update it every month. And in the past few months, the dynamics have been moving around quite quickly. A few months ago, of course, there was an expectation of extremely strong price growth. Less so now. And the third point to make is that it's clear to me that we are seeing significant price reductions pretty much wherever you look. So the spruiking that's been going on about there's still plenty of opportunity and, buy now may be true, but the fact is that vendors have to be realistic. If they're going to move their property now, they need to be able to meet the market. And the market is somewhere between 10 and 15% lower than where it was on average, in my view. I think we're going to see further falls in the next few weeks because listings are still quite high in some areas. But when spring comes along, that's normally pretty buoyant. I think this year could be quite interesting because we'll be effectively coming into spring just as interest rates continue to rise further. And as I've highlighted a few times before, the point here is this, that the trajectory of interest rates and the availability of credit is one of the most significant identifiers of what's going to happen in the property market. And the fact is that interest rates are going up. Credit availability is much tighter. The typical borrowing power is down about 15%. So there's no surprise to me at all that we are seeing now price falls of between 15 and 20%, perhaps even more. And I guess we're going to go on seeing that over the next few months. So check back. I'll probably do some more of these. Cookie Boy will send me over some more data. I'll make some more shows. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.